Hey traders, how's it going? Brandon Carter FX here, aka Mr. Golden Ratio, and the use of Fibonacci. The use of Fibonacci and proper usage of Fibonacci. It's a very powerful tool that can be used in confluence with everything that you've learned thus far when used properly. And basically, Fibonacci, for those of you who don't know, is a tool that can be used in helping identify places in which you're anticipating a market to retrace to before extending further upside, or retrace to before extending further downside, depending on whether you're in a bullish or bearish scenario. Following the chapters that we've already covered, you already know what these lines and the colors form mean. The purple lines are strong support resistance areas based on the higher time frames of the daily and weekly, and the white lines are our powerful hold numbers, and you know very significant to trading when used properly. So how do we identify exactly how to use Fibonacci? Well, there's two ways to use Fibonacci. There are only two ways in which to use Fibonacci. Number one, identifying a directional change in the market. It helps you identify where you can expect that market to go. Or keeping in the same direction, it helps you identify continuation trades. So those are the two ways. After directional change in the market, helping you to identify where you can expect the market to go, and if expecting continuation, um, looking for continuation trades, helping identify where you can expect the market to go, whether it's a continuation or directional change. It helps you identify where you can expect the market to go, where you can expect the market to retrace to before extending further upside, or retrace to before extending further downside. So following the rules that you've already learned with support resistance, the significance of the whole numbers, and uh, the trend lines, and those rules, applying those rules, give you a scenario of how to use Fibonacci. All right, so we have our chart marked up. Let's say, you're following your rules, right? You already know what you were looking for. You're looking for the break and the retest, right? Break and close above the trend line. Now, how would you use Fibonacci? Let's get the Fibonacci tool. So you may be saying, I have problems, you may say to yourself, I have problems identifying where to, where to start my Fibonacci, where to drag it to, where to, what's the A, identifying the A and the B, to anticipate the C leg, right? So how do you identify that? Well, by definition, as far as how I use Fibonacci, by definition, the way you identify that is depending on whether we're in a bullish or bearish scenario. Being that we are in a bullish scenario, so, because the market back here was falling, and we're anticipating at some point that it would rally, but following the rules, boom, one of the rules was met here, waited for the break. Okay, at this point, we're in a bullish scenario. Now, how do I identify where, at this point, how do you identify how to use Fibonacci? Well, this is the directional change scenario, not the continuation of the same direction, but this is the directional change scenario going from bearish to bullish. Would I identify it by the most recent swing low made before the directional change, which the directional change happened right here when, according to our rules and what we look for, now looking for bullish trades, which that happened here when we got the 4-hour closure above this descending trend line. So now at this point, we're looking for bullish trades. So now How do I find the low? Well, the most recent low made before the bullish change. Well, you say, what is the most recent low? How do you know? Well, I look at it as these dips here. Well, the most recent low made, pretty self-explanatory, which is obviously here. Two to three candlesticks to the left, or 2 to 3 candlesticks to the right, being higher than the center wick low. So that being 2 to 3 candlesticks to the left in this area, 2 to 3 candlesticks to the right in this area. Okay, drag that. How do you find the high? Well, we see that break, but we wouldn't have known that that was going to be a high right there until the market turned around. So we couldn't drag it from here to here, right? Because we didn't know at that point in time that that was going to be the high. All we knew was that it broke, right? The market broke out. So the most recent completed A B area identified by a low identified by 2 to 3 candlesticks to the left and 2 to 3 candlesticks to the right, being higher than the center wick low. So I have a rule, and I want you guys to take notes. You guys need to take notes throughout this, right? So I have a rule. If we get a retracement that's, you know, 618, 50, or 38.2, we can expect a 61.8 extension to be hit. If we have a retracement that's deeper than that, say the 78.6, which you can see right here, then you can expect a 127 extension to be hit. All right, that's just my rule of thumb when using Fibonacci. If we have a 61.8, 50%, or 38.2 retracement hit, we can expect a 61.8 extension to be hit. If we have a 78.6 retracement hit and that's respected, you can expect a 127 extension to be hit. When you're drawing your fibs, the C always becomes the new A. And as you see, we have the 2 to 3 candlesticks that formed right here to the right and to the left. So now we have already identified the C, which was at the 50, right? Was at the 50% retracement. So now the C becomes a new A. A, B. How do we identify that as being the B, which is from swing low to swing high? How do we identify a high? 2 to 3 candlesticks to the left, 2 to 3 candlesticks to the right, lower than the center wick high. That's how we determine the high. And the 2 to 3 candlesticks to the left, 2 to 3 candlesticks to the right, higher than the center wick low is how we identify the low. Okay, in confluence with the fact that we've broken the trend line and anticipating a retest. All right, so boom, now we have this A, B, came down to the 50, started to rally a bit, just a little bit, came down deeper to the 61.8, continued down to the 78.6, as you can see right here precisely. What is that in confluence with? The backside retest of this trend line. So that's very strong confluence. A, B, C, and what did I say in regards to using Fibonacci? If it retraces deeper than the 38.2, 50, and the 61.8 and goes down to, say, for example, the 78.6, then we can expect a 127 extension to be hit as opposed to a 61.8 extension to be hit. So deeper than the 61.8 retracement, such as a 78.6, then we can really only anticipate a 127 extension to be hit. But above that, say 61.8 and higher, like 50 or 38.2, then we can expect the 61.8 extension to be hit. Now, how do we use that in confluence with the rules that we learned in the previous, where you say, how do we know that it's going to, respect the 78.6? How do we know it's not just going to continue to fall and fall and fall and fall? Well, we've put safety measures in place in regards to trading, as you guys already know from what you've learned in the previous markets. I mean, in the previous chapters, when trading this market. What was that? How do we know? Well, because we're not just gonna jump in right here. We're not just gonna. I mean, if you want to be risky, yeah, you can do that. You can say, you know what? Well, I have enough confluence. It's at a fib level. It's at the backside of the trend line. That's enough confluence for me. I'm willing to take that risk to potentially get in at a better price. You can do that. You can absolutely do that if you're a riskier trader. But we like to uh, you know, minimize risk as much as possible. So we have the safety measures in place to do so. How do we, what are those safety measures? Well, for example, the trend line. At that point, as the market is approaching these areas, we would be drawing on our trend lines. Where would we draw them at? Well, number one, we'd get a little more detail, drop down to say the hourly, right? And follow the rules that we've already learned. You could minimize risk more and apply your trend line and say, you know what? I'm not sure if the market is going to respect this area. I need some more confirmation. So now we have a few things that are in confluence, right? So now we have that breakout that happened, anticipating the backside retest, as well as coming into a important fib area, as well as coming into previous resistance now becoming support. That's a lot of confluence already, but we need a little bit more. We want some more confirmation to decide whether or not we're going to take this long trade. We're going to add one more layer. We need a break and close above a trend line. Boom, that happened there. That happened right here. Now you, without a shadow of a doubt, you can say, you know what, I'm really confident now. And what you could do at that point is, we've already discussed how we identify our low, right? So boom, obviously is there. How do I identify our high? We've already heard the description of that. At least 2 to 3 candlesticks to the left, 2 to 3 candlesticks to the right. And then now we're anticipating that same area, one of those fib levels. What do you know? It's in confluence, 61.8, also respecting the backside of this trend line after the breakout. A, B, C, boom, hit the 61.8, just blasted right through it. Extension right at that moment. Let's get rid of this fib here. Right at that moment. And as we know, C becomes the new A. C becomes a new A, B, right? And we're anticipating, what are we anticipating? It to come into one of these important fib lines. And as it's dropping, as the market is, as we've identified the B, anticipating the C to come into one of these fib numbers, what are we doing as it's doing that? We're drawing on, if you want that extra confirmation, we're drawing on, trend lines. As the market is dropping to your preferred fib levels, follow our trend line rules from our trend line chapter. Okay, boom. So none of this, let's act like none of this was here, right? Let's act like none of this was here, and we just have the A, B, anticipating the market come down to one of our fib levels. As it's coming down to our fib levels, we're applying our trend line and anticipating the break and close above it. Boom, it happens right here. Oh yeah, and that's the other thing. It retraced to the 61.8, right? So, but boom, we got our further confirmation with that break and close above. So now you could absolutely, if you wanted to, put in some sort of, order around in that area, have about a 35 to 45 to 50 pip stop, or wait for a retest of the backside of the trend line, right? Boom, had your stop below here, have about a 40 pip stop, and at that point anticipate the 618 extension to be hit. Well, let's see what happens as we scroll forward. So would have got in around here somewhere. Market would have went in our favor. Would have been about 80 pips in profit. Market would have came back to round about where we entered at. Would have carried along, and then finally, boom, we got the 61.8 extension hit. We've got the 61.8 extension hit. As we know, the C becomes the new A. So we have the A, B, C. D. That 61.8 extension was hit, blasted through right around this area. And now we have the new AB. A, B, anticipating the C. And look at, what do you know? The C is in confluence with potential C. 61.8 area, strong previous resistance, potential to act as support here, or come into this 50 fib area, which is in confluence with the whole number of 108.000. But this is how you use fibs in confluence with everything else that you've learned in regards to support, resistance, trend line breaks, so on and so forth, and how to properly apply it. Always remember that the C becomes the new A after an extension has been hit. Where it retraces to, the retracement level that it hits determines the extension that you can expect it to hit. Not that it will be guaranteed, but that you can expect it to hit. So like I said, if it's a 38.2, a 50%, or a 61.8, then you can expect a 61.8 extension to be hit. If it's deeper than that, like say for example a 78.6 retracement that's respected without violating the A, then you can expect a 127 extension to be hit. So now we're on the 4 hour. So that's a scenario in which how you can expect to use Fibonacci after a directional change in the market. Now let's say you don't necessarily expect a directional change, but you're just trying to figure out where to get in, or where to draw your fib in anticipation of continuation to the downside or the upside. Let's say you see the market's dropping. You don't necessarily expect it to start going bullish, but you want to be able to identify where you can expect the market to retrace to before continuing in a continuation trade further to the downside. So let's say, for example, following our rules, right? Say the market was way back here. Let's say nothing to the right or within this box and to the right of this box was here yet. Let's say everything, the market just, we're at live market here. So you're trying to figure out, all right, where do I even begin? Where do I even start? Number one, following our rules, would have had this. Boom. You already know how to draw trend lines from the previous chapter properly. Would have had that. Boom, 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 boom. You say, wow, well, the market's already fallen so much. Where do I even begin? Where do I even start to draw my fib and anticipating, a turnaround to be able to get in? let's say the market, boom, it broke through, retraced, retested the backside, was falling. You're wondering, well, where do I draw my fib? Where do I even start? We wouldn't have necessarily got in at the retest of the backside of that trend line. What we would have done in that area, added more confluence and more confirmation. We're anticipating the retest of the backside of the trend line, but we're not just going to get in at the retest of the backside of the trend line. We'd wait for a break and close below. Boom. It happened there. And then we could have gotten in at that point. But again, we were looking at Fibonacci. So market's falling. Where can I expect a turnaround? Well, you look at the most recently completed ABC. Identified, just look at the market structure. The big bounces, right? Identified by the most recent ABC completion. A, B, C, 78.6. Look at all this confluence in this area. You got the retest of this backside of this trend line. You got the touching this descending trend line and retesting the backside of this ascending trend line. A, B, C, 78.6. Wouldn't have necessarily gotten in there. You just need a little more confirmation. Boom, break and close below this trend line. You have every reason to believe the market is going to fall at that point. Almost 100% that the market is going to fall at that point. But again, where is it going to go to? Well, we got the 78.6 retrace. We can at least anticipate a 127 extension being hit. Booyah. It happened right there. Extension hit. Now, A, B, C, D. And in fact, it even hit the 61.8 extension. If the market is volatile enough, it will do that. So now at this point, you're anticipating a turnaround. Not guaranteed, but you're anticipating, all right, where to get in. Where's the next ABC? Well, now the C, the previous C becomes the new A. So now we got A, B, C, D. Look at that. Extension hit 61.8. We had a less than we had a less than 61.8 retracement happen. So we had the A, B, C, and it's like, how do we know it's going to turn around there? How do we know it's not going to retrace deeper and go up to the 50 or the 61.8? Well, follow the rules that we have in place for confirmation. As it's approaching that fib level, boom, it hit that A, B, C, or anticipating the C, but as it's coming up into our preferred fib levels, as it's doing that, we are doing what? We're drawing on our trend lines for further confirmation. Boom, break, close below, backside retest. We know in this area we want to get in. What is that also in confluence with? 111.00 whole number. Think that's a coincidence? Well, I've got news for you. It's not. It's no coincidence. It's no coincidence. Break and close below to confirm that it's likely that it's not going to retrace any deeper than the 38.2. Confirmed by this trend line break and close below, backside retest, and anticipating further downside. Also in confluence with the very strong and powerful whole number of 111.00. No coincidence there. And anticipating the 618 extension to be hit, which eventually not quite there, retraced back, and boom. And then the market turned around from that point, right? Back to the 4-hour time frame. So, whether you're going long or going short, in a short, In a short market, you're dragging your fib from swing high to the most recent swing low, anticipating the retracement, looking for an extension. Bullish scenario, you're drawing your fib from swing low to swing high. In a bearish scenario, you're drawing your fib from swing high to swing low. So bullish, right, from swing low to swing high, anticipating that fib area to be met, confirmed by as it's reaching that level, putting on your trend lines and waiting for that closing break above. And just the opposite in a bearish scenario, where you drag your fib from swing high, most recent swing high to swing low, for example here, and not just hopping in there, but waiting for further confirmation. And in this case, because it's a bit choppy, would have dropped down to a lower time frame like the hourly, and confirmed it with this. Booyah. Broken close there, continued to fall, but we're expecting that retest, right? But as it's going to retest, we're looking at the fib levels, we're looking at price levels. What do we have up in here? 109 dot what? 109.00, whole number, anticipating the 618 extension to be hit, and boom. And you can find these every day in the market, every day. And I've come to the point where I'm able to identify these areas without even using fibs. What I could have eyeballed that and told you that that was a 61.8 retracement without even, pulling out the Fibonacci tool. Trendline break, trendline break, trendline break, trendline break. When used properly in conjunction and confluence with everything else you've learned, and looking at the bigger picture in this scenario with this particular trend line, as far as directional change, then boom, break and close above, and then following those rules, trendline break, trendline break, trendline break, up. Trendline breaks identified by break and close above, or below, depending on if you're bullish or bearish, the trend lines. Where a lot of people mess up is they don't wait for the close of the candles. They don't wait. They just kind of wait for the market to get to a specific level, and they just put an order in without waiting for the close. And that's where most people mess up. The impatient, the FOMO, fear of missing out, extension was hit there. So now we have, where can we expect that market to fall to before continuing potentially higher? Well, the most recent swing low to the identified swing high, and coming down into the same area. We have a lot here to suggest bullish movement after the market reaches here. Why? Resistance could become support. What else do we have here? A 78.6 and 61.8 fib. What else do we have here? This ascending trend line here that it could potentially respect to continue further to the upside once it reaches here. But we're not just going to enter here as the market is approaching here. What we'll be doing as the market is falling, we'll be, following the rules and what's identified, how we identify where to draw trend lines. We'll be drawing our trend line on as the market falls to our preferred fib levels, in confluence with everything else. And it'll probably be something like this. The market will do this, and if it's going to be respected, if this trend line is going to be respected and this trend line, this descending trend line here, is going to be violated, we'll wait for that break and close above this to anticipate that 61.8 extension to be hit, which look at that. A, B, potential C right here, right? 61.8 extension. What is that in confluence with? 111.00 whole number. Do you think that that is coincidence? If you say yes, then you're a fool. It is not coincidence. It keeps happening over and over and over again. It's no coincidence. Put all these pieces together and you have a very powerful system, in which you can have confidence to expect that the market is going to respect these levels. Like, for example, when the market reaches here, we already know that we're anticipating the market to turn around after reaching a significant Fibonacci extension level. But what else is in confluence? Well, had you not known about the powerful and the significant, the power and the significance of the whole numbers, you probably wouldn't have had no reason further to believe that the market could possibly pull back here. But now you've got some extra confluence with the 61.8 extension being hit. That confluence being the whole number of 111.00 being there, which that in itself is confluence that you probably didn't previously have, but now you do. Um, and if it did turn around there, let's just say we had A, B, C, D, 61.8, and the whole number of 111 hit, and the market turned around, and that look at that 61.8 whole number of 108.00. It keeps repeating. Why is that 61.8 always around, more times than not, always around powerful whole numbers like that? It's not a coincidence. But let's say that was respected. A, B, C, D. And then, as you know, C becomes the new A. A, B, C. Look at that. 61.8. Where's it coming down around to? 109 round number. What else is there? We have this, what would be resistance right here. And as the market came back down, could possibly act as support. Resistance acting as, if it was respected, come down as support. Support at what? The 61.8. At what else? Whole number of 109.000. What else? This ascending trend line here. This ascending trend line here, to help it also, uh, you know, be respected and find further upside. And what is that extension at that point? What is that extension? So we would have A, B, C potentially, and if that is respected, that 61.8 area, then we can expect a 61.8 extension to be hit. And if it is, what is around there? Wow, look at that. Right on the dot. Look at that. 61.8 in confluence with what else? That you probably wouldn't have paid attention to previously. 113.000 whole number. Right on the dot. You have a ton of reason to believe the market could potentially turn around at that point, because you got the strong whole number, psychological, quote unquote psychological number of 113.00. You have the 61.8 extension. We're already expecting the market to turn around because of that alone, but in confluence with that, so A, B, C, D. And let's just do one more. Let's see what happens. If that was respected, A, B, C, potentially C, well, that would be the backside of this trend line. That would be the whole number of 110.00, and that would be the fib level of 78.6 in confluence with what would be this resistance area. Previous resistance, previous resistance becoming support, backside of the trend line, fib level, whole number. And just out of curiosity, I wonder what the extension of that fib level would be. Well, like I said, right? 78.6, we're expecting a 127 extension as opposed to a 618. Well, what's around there? Oh my God, 114.000. Whole number. Is that a coincidence? You cannot tell me that that's a coincidence at this point. These whole numbers, these Fibonacci levels, when drawn on correctly, after following the rules of the support resistance being broken and trend line breaks and everything else you've learned, when you put it all together, does it or does it not make sense? And is it or is it not coincidence? I think I've proven by now that it is not coincidence. And again, that's why they call me Mr. Golden Ratio, because, without even drawing on these fibs, I can pretty much eyeball, oh, that's a 38.2 retrace. That's a 61.8. That's a 78.6. For example, even this here, this is most likely a 78.6 retracement level. A, B, C, boom. What do you know? 78.6. Confluence with what? Ascending trend line going on here. It just repeats over and over. And we could have, even in this scenario, well, how do we know that that trend line and that 78.6 level is going to be respected? How do we know? How do we know what's just going to keep dropping? What further confirmation could we have had? Well, we could have dropped down to a lower time frame for one, get more detail, and then at that point we could have drawn on our trend line and waited for what? The break and close above, which happened here, and it retested and continued up. So this is how you properly use fibs. This is how you properly draw them on. Even if we go as far as the daily, right? If we go as far as the daily, A, B, C, D, 61.8 extension, hit. C becomes a new A. A, B. We know how to identify that being as B because what? 2 to 3 candlesticks to the left or right, right? After extension was hit. So A, B, 38.2 retracement level hit. A, B, C, 61.8 extension hit. D, C becomes a new A. A, B, C. So now A, B, C. We're right at the 78.6. We're right at the 78.6 on the daily. We're right at that level. And can anticipate potentially market falling. And if it's going to respect the 78.6, we're not just gonna hop in. This is the daily chart. We're gonna hop down to a lower time frame, number one, and look at what the market is doing in this area, following our rules before we take any positions. It's a little choppy, need a little more detail. All right, well, let's get a little more detail. Let's drop down to the hour, see what it's doing on the hour at this all important 78.6 zone. Okay, at that point you already know what we would have done. Waited for that break and close. Boom. We have great probability, but that may not be enough for you. It may not be enough for you. You could have said, you know what, I need another trend line break and close. Following the trend line rules in that chapter of how we identify where to draw trend lines, boom, it happened right there. Break and close, trend line drawn on here. Retest of either the trend line or previous support as resistance. Boom. All right. It's a likelihood that this market may drop back down, potentially to previous resistance to act as support. So it may drop from there to there, which is around a very significant resistance level, to potentially act as support and then rally further back up. So this is how you use fibs. This is how you identify your fib levels to draw on. It's a great tool to use in confluence with everything you've learned already, and the significance of the support resistance, the whole numbers, trend line breaks. So with that being said, we'll move on to our next chapter, and I'll meet you guys in the next chapter. How do I actually enter with tight stop? How do I actually place my order, and how do I know where to put my stop loss, and how do I know if it's violated, if my stop loss is violated and taken out, that the trade itself is still valid? How do I know if it's not valid anymore? Things like that. So you'll learn that in sniper entries and exits on the next chapter. The next chapter, sniper entries and exits.